All right, just a few minutes left until the closing bell rings on this Tuesday. Joining us right now from the CME Group is Ben Lichtenstein, president of TradersAudio.com. He actively trades E-mini S&P 500 futures contracts. And for those not familiar, those futures represent about 1/5 the size of the standard S&P 500 futures contracts. Also with us, Hans Olsen, back with us, I should say. He is Chief Investment Officer over at JPMorgan Private Wealth Management, where he helps manage about $120 billion. Hans will give us some insight into what his client's risk appetite is and his current asset allocation. We're going to get to that, but I got to talk Fed. Did we get what you expected from the Fed today? And are you surprised at all by some of the market reaction out there?
I'm not surprised by what the Fed did, right? I think pretty much we were expecting, the sun of quantitative easing, right? This is QE light,
right?
And I think it was largely expected. And in fact, it would have been disappointing if they didn't do something like this. Market reaction, we got a nice pop.
But does that make sense to you? Because they put out a lot of kind of warning words about the economy.
Yeah, I think it was looking for a reason to go up, to be frank with you. I mean, I think it was a relief that it got what it wanted, but then the reality of the situation set in, which is, hey, look, this is an economy that's shuffling along. It's not sprinting, and that's really not good news at this point. I mean, what you'd normally think about at this point in the cycle is sort of the Keynesian handoff, right, from the public sector to the private sector. The private sector is saying, hold on, we're not quite yet. So it's more like a Keynesian standoff.
Right.
I wonder if this can continue. I mean, the Fed, obviously, their preferred method is wait and see. Now, they're giving us a little bit, and the market is going to expect a little bit more as we go forward, right?
I think the bigger issue here ends up being this whole debate, this chatter around deflation, right? Because there's not a shortage of money. The Fed's made plenty of money available, right? $2+ trillion balance sheet. The question is,
in the span of a year.
In the span of a year, right? What, 900 billion to 2.3 trillion? An enormous increase. It's gone parabolic. The reality is that there's an unwillingness to invest, right, which is part of this deflation chatter. And the question ends up being why.
This is the pushing on a string that we always hear about.
Yeah, but even more fundamentally, there's capital. For all that it's brave, it hates uncertainty, right? It detests it. We've talked about this in a number of times in the past. Where we are right now is that capital has a lot to be questionable about, right? Taxes, regulatory regimes, new initiatives, all creating a cauldron of uncertainty.
Right. Ben Lichtenstein, he's president of TradersAudio.com. So, Ben, let's bring you into this discussion in terms of the market. You've had almost a couple of hours here to kind of digest what the Fed did and how it's kind of played out in the markets here. What's your takeaway?
Well, I basically see it as essentially a non-event, very much like Friday's unemployment data for the most part. Again, we've been moving around. We've seen a lot of energy in the market. Probably one of the better volume days that we've seen in about 5. But for the most part, again, we have yet to breach any major levels of support or resistance. This market has been developing horizontally for the last 5-6 days at this point. And basically, when it's developing horizontally, you have these overlapping value areas. And that's the case right now. Until the S&Ps breach that level to the upside around 1126, 1127 with some conviction and continue in that path with energy and volume, we really, again, are just kind of trading sideways at this point with very little conviction. There's an enormous amount of uncertainty out there. While we've made our way through the earnings season and we're kind of away from some of the concern that we saw overseas for a couple weeks now or a couple months now, again, this market is basically, again, give the benefit of the doubt to the bulls for the most part in the run-up that we've seen on an intermittent time frame, but for the most part, recently it's basically just sideways.
Exactly. Hans, we've been talking about all the bearishness out there on the part of economists, and it's true. Brendan was talking about it today. Julie was talking about it today. We had a Business Week cover story on all the bears, how famous they are, and the Fed's getting a little bit more bearish, but it's still not the point where you can buy because everybody in the market's petrified, right? I mean, we're still unchanged year to date. We're still up 10% over the last 12 months. It's not like everybody's going in there and selling like crazy.
No, it isn't. I mean, the fundamentals actually look pretty good, right? I mean, the Q2 numbers were spectacular, but when you start digging around inside them, they actually confirm that within the profits picture, the story's good because both earnings are up and the quality of earnings have gotten better. So I don't think I think that's the reason why you see people are not selling.
Is that the one thing that divides economists and investors? I mean, is that why you see this? I don't use the word dichotomy.
Sorry.
Well, you have a bipolar world, right? You have the economics piece, which is really quite gray right now, and then the earnings piece actually is a much sunnier picture.
Well, Hans,
So,
Adam out here in the newsroom, I'm curious. You said the numbers coming in better, but is 10% sales growth year over year good enough? I mean, yeah, it's better, but is that really good enough?
From the environment that we've come out of, I think that that's directionally correct. So yes, it has to be good enough at this juncture, especially when you're looking at GDP growth, meandering along at 2.5%. That's not bad.
Ben, what do traders think about this? I mean, investors aren't terribly bearish. Economists are going off the deep end. But you guys, especially in Chicago, have to be concerned about the unemployment that you see better than we do, and the revenue growth that is at least tepid.
Yeah, well, there's obviously an enormous amount of concern out there. As I mentioned, that's one of the things that's kind of been keeping some of the energy at bay, if you will. Also, keep in mind this is typically a very light volume trading month, so we're going to see kind of a lot of whipsaw type trade with very little follow through associated with that. One thing that a lot of traders were talking about this afternoon was that strong move that we saw in the 30-year, getting up above 130 in the actual futures contract. I think that touched at one point below 4% in the actual rate there. So there was also, we've been hearing a lot of talk about the dollar, the weakness in the dollar that we've been seeing. So a good strong move in oil up above $80 a barrel. So we're starting to see some movement, starting to see some energy in the market. But again, with basically everybody just assuming that the Fed's going to leave the rate as is, that's really kind of keeping things, keeping the speculation at an all-time minimum. As I mentioned already, we've been seeing somewhat low volume here coming into this summer type trade here. So there's a lot that traders have been talking about. But again, for the most part, a lot of uncertainty.
Adam did something earlier and did the FOMC statements side by side, what we heard in August and what we got in June, the month before. In June, they said the economic recovery is proceeding and that the labor market is improving gradually. Today, we got the pace of recovery in output and employment has slowed in recent months. It's a very different tone, if you will. How can corporations continue those good profits at this point if the outlook is so uncertain?
Well, you remember, right, especially with the S&P 500, 40% of the revenues, the profits are from non-U.S. sources, right? So that's the benefit of international trade. So you can continue to see that happening. I think at the end of the day, your margin of safety is in what you pay for something. You're not paying a lot for these earnings right now. For these larger, especially these larger cap companies, they have a global footprint. And they're growing on the top line, and that growth on the top line is passing through to the bottom line. There's the beginning.
But they're not hiring aggressively, and that's the big kind of nut to grind.
That's true. And that remains one of the big problems out there, and that feeds into this deflation chatter that is the sound of which is getting louder and louder.
But we see, don't we, after the last couple of recessions, a jobless recovery. Is that part of the new normal?
It's a good question. The last time that we were at a place like this, right? It was 2004. We were coming out of recession. We weren't putting up jobs every month at a rate to even replace the new people coming into the the labor market. Then you had the benefit of the ability to take on a great deal of debt to reinflate the economy. The debate right now is, do we have that ability? So the money's being put out there. It's not being used. Hence, part of this deflation chatter.
All right, hey, Hans, thanks so much for joining us. Hans, Olsen, I want to thank also Ben Lichtenstein. We are going to